260 million US dollars. That's the amount of cash that developing countries managed to raise in a range of tax audits through a pilot program that let them get access to specialized tax audit advice and expertise. At least $100 million of that cash was recovered in one country alone, Zimbabwe. But without country-by-country reporting rules in place, just how effective can this program of tax inspectors without borders be? CCTV's Ramah Nyang put that question to James Karanja, the head of the OECD's Tax Inspectors Without Borders program.
Developing countries have that challenge that first they may not have been involved in that BEPS project, but are now welcome to join that process through the inclusive framework that the OECD have set up. And through programs like the one we run and with tax inspectors would be to help them to quickly bring, to turn around tools, to show them tools that they need to use and to turn the programs fast enough to actually recover revenue. So country by country reporting, we're far off. We're not yet signed on to transparency tools. We're not yet signed on to, switched on to the implementation that is required. Or oftentimes, countries don't actually know the extent of the problem. So, we're saying there needs to be a stronger political will. We need to make people more aware of just how much tax they are losing already.
The pilot audits, before this project got formally off the ground in July last year, the OECD said that about $260 million was realized from these pilot audits, and quite a bit of that was actually raised, about 100 million or so, in new tax revenues in Zimbabwe.
That's correct.
Could you tell us more about this? What exactly, how did this money come about? Because it's a bit staggering to sit back and look at that number today and realize that countries, as you said, simply didn't know that this was cash they could actually get access to.
That's correct. I may not be at liberty, for one, say, to disclose the exact circumstances under which the money was recovered. The program does seek to keep the confidentiality, the taxpayer confidentiality, and keep within the rules of each of those countries. But what we could say, and this is consistent in the 2-3 years of the pilot project, there's 260 million from 8 different pilot countries where we rolled out an effort to see this actually work. And Zimbabwe, like other countries we're working in, probably have never had the resource to be able to pick up things that were blatantly in breach of the tax code. So the idea of having a tax expert come in, identify your problem, identify how much loss you're making. In the case of Zimbabwe, as you say, it's astronomical figures.
When you talk about the OECD, especially in the context of African countries, one of the main arguments would be, yeah, but it's a club of rich Western states that have nothing to do with our context. A lot of these multinationals we're talking about are based in those OECD states. So why should we trust you? Why should we come to you for help? Isn't that a problem that you run into?
Well, that is going to be, we recognize there's a historical perspective about this, but it's important to note that in the period post the global financial crisis, a lot of what you see in the initiatives that the OECD is running, like the Global Forum on Transparency, now with over 135 countries, which includes, not just the member countries of the OECD, and the BEPS project, which had had input from a lot of developing countries as well. The multilateral instrument to amend the tax treaties now has over 100 countries participating in it. So I think there's been a growing realization since that crisis that the world can no longer just operate in one prism. You've got to have everybody. We need to ensure that everybody is on board. International rules have to be implemented internationally so that you don't create gaps.